So, how can you ensure you're not unknowingly stepping into a financial quicksand? By mastering the art of reading balance sheets. At its core, a balance sheet comprises three essential components: assets, liabilities, and shareholders' equity. Assets are resources owned by a company that can be used to generate income. Examples of assets include cash, inventory, and equipment. If you can see it, touch it, or turn it into money, it's likely an asset. Liabilities, on the other hand, are what a company owes to others. They're like the debts you'd need to pay after a lavish poker night. Examples include loans, accounts payable, and accrued expenses. Shareholders' equity, often referred to as net assets, represents the residual interest in a company's assets after deducting liabilities. In other words, if the company were to sell all of its assets and pay off all of its debts, what's left is the shareholders' equity. The basic accounting equation that ties these elements together is assets equals liabilities plus shareholders' equity. It essentially means that a company's assets are funded either by borrowing or by the owners. Sounds simple, right? But of course, we're just scratching the surface. Now, let's dive deeper into the rabbit hole and see how these numbers can tell us captivating stories about a company's financial health. And to do so, let's look at Microsoft's balance sheet. Assets are divided into two categories: current and long-term assets. Current assets are resources a company expects to convert to cash, sell, or consume within 1 year. Think of them as the cash or cash-like resources that are readily available for the company to use in the short term. Cash and cash equivalents are precisely what they sound like: cash in the bank and assets that can be quickly converted into cash. Short-term investments, also known as marketable securities, are investments a company plans to hold for 1 year or less. These may include stocks, bonds, or certificates of deposit. For a cash-rich company like Microsoft, it makes more sense to temporarily invest $90 billion rather than allowing it to languish in a checking account without generating any returns. Accounts receivables represents the money owed to Microsoft by its customers who have purchased its products or services on credit. For instance, if a corporate client of Microsoft buys a large number of Microsoft Surface laptops for its employees and promises to pay within 60 days, that amount will show up as accounts receivables. Inventory for a company like Microsoft would include physical items that it intends to sell, such as Xbox consoles, as an example. On the other side of the horizon, we have long-term assets. These are resources a company plans to hold for more than a year. A significant component here is property, plant, and equipment, also known as PP&E. It includes the company's physical assets like buildings, land, vehicles, furniture, machinery, and equipment. For Microsoft, this includes their office buildings, data centers, and equipment. If a company has a high proportion of its assets in PP&E compared to its annual revenues, it could indicate that it operates in a capital-intensive industry, which is not the case for Microsoft. Just as a coin has two sides, our balance sheet story wouldn't be complete without discussing liabilities, what the company owes. Just like assets, liabilities are also divided into current and long-term liabilities. Current liabilities are obligations a company anticipates to pay off within a year. A typical example of current liabilities is accounts payables. These are the amounts the company owes to its suppliers. For instance, if Microsoft orders computer chips from a supplier and promises to pay within 30 days, that amount is classified as an account payable. Another important item in this section for Microsoft is unearned revenues, also known as deferred revenues. which represents payments received by the company for goods or services it has yet to deliver. For instance, when customers pay upfront for a 1-year subscription to Microsoft 365, but Microsoft has yet to fulfill most of that service, that money is counted as unearned revenue. Let's now talk about debt. Microsoft has 2 line items related to debt on its balance sheet: current portion of long-term debt and long-term debt. The first one refers to the portion of long-term debt due within the next year, while long-term debt is debt due more than a year from now. A key concept here is net debt, which is calculated as total debt minus cash and cash equivalents and short-term investments. Simply, it tells us how much debt a company has if it uses all its readily available cash to pay down its debt. Alright, ready for some financial wizardry? To make sense of whether the net debt level is manageable, we compare it with the company's earnings. And that brings us to the net debt to EBITDA ratio, where EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This ratio gives us a sense of how many years it would take for a company to pay off its debt, assuming debt and EBITDA are constant. Now, Microsoft has a negative net debt, meaning it can pay off its debt entirely with readily available cash. So, we will use a fictitious example to illustrate how the net debt to EBITDA ratio works. If a company has a net debt of $10 billion and an EBITDA of $50 billion, the resulting net debt to EBITDA ratio is 0.2. This implies that if our made-up company dedicates all its EBITDA to debt repayment, it could pay off its debt in just 0.2 years, or about 2.4 months. If, on the other hand, the EBITDA is $200 million and its net debt to EBITDA ratio is 50, it would likely take 50 years for the debt to be completely paid off. As always, this ratio should not be viewed in isolation. A low ratio could indicate a strong financial position, but it could also mean the company is not leveraging debt to its advantage. Meanwhile, a high ratio may signal risky debt levels, but it might also mean the company is strategically investing in growth. Therefore, it's always wise to compare this ratio with industry peers and consider it in the context of the company's overall financial picture. Let's now take a detour and visit the equity territory to discuss return on equity, or ROE. It measures a company's efficiency in generating profits with the money shareholders have invested. ROE is calculated by taking the company's net income and dividing it by shareholders' equity. Based on its fiscal year-end 2022 results, Microsoft has an ROE of 43.6%. So, is it good or bad? Like with most financial ratios, the ROE is most useful when compared to other companies in the same industry. An ROE that is higher than the industry average suggests that the company is more efficient at using its equity to turn a profit. However, a high ROE can sometimes result from high financial leverage, which means the company has a large debt. So, looking at the bigger picture is essential. Becoming proficient in understanding balance sheets is like any skill. It takes practice. So don't get discouraged if you don't get it all at once. Keep practicing, keep learning, and before you know it, you'll be analyzing balance sheets like the best investment analysts. If you found this video helpful, don't forget to show some love by hitting the like button and subscribing to our channel for more financial wisdom. As always, we appreciate your continued support. Stay tuned for more enlightening videos to boost your financial acumen. Until next time, happy investing everyone!